quiz, that'd be nice, thank you. Is that what you're saying?
Yeah.
Yeah. What we're doing is we're starting with the quiz, chapters 3 and 4 from the summer. You know, that one's online. So, you know, just as a approach to this thing, I think I'd set it up like a financial statement and write down everything I know. The only difference between this one and the one that you had on the first quiz is you don't have zero beginning, zero beginning balances. We have beginning and we have ending. So let's do them. No problem. Okay? And then we're going to have the income statement for the current year, huh? Okay. So, what do we know? Let's write down everything we know. So tell me what we know here about beginning and ending balances, assets, liabilities, and equity, revenue, expenses. And if I were you guys, I'd just go down a column and write them all down and go down the next column and write them all down before I started solving anything. Because the danger is you'll forget to write something down. And then, you know, you kind of, you'll go crazy trying to solve without all the pieces. So anyway, what do we know?
600,000 assets.
Okay, 600 in assets. Okay, that's fine. Beginning or ending? Really? Which one's beginning? Which one's ending?
Oh shoot, I wasn't looking at that. We have 700,000 beginning.
700 beginning. Oh, okay. All right. And ending is 600. So read carefully. What else do you know?
330,000 liabilities.
Beginning or end? Okay. What else do you know? Just writing stuff down. Come on, you guys. Come on. What else do you know?
400,000 in revenue.
I had 400 in revenue. Okay. What else? 10 in dividends. Oh, dividends are going to come out of what? Out of equity. Which equity account? Say, retained earnings, right? So I'm going to have contributed capital and retained earnings. And in retained earnings, I'm going to have a debit of 10 for dividends. Okay? I'm just writing down what I know. It's no big deal. What else?
Contributed capital.
Is it okay? Is it contributed capital at the beginning or the end? The end is 100. All right. Okay. What else do I know? The ending retained earnings is 150. All right. What else you got?
Owner's investment.
Oh, an owner's investment would have been 50, increasing contributed capital, right? So, start solving stuff. What can you solve? You can't solve these two because there's two unknowns. You can't solve these two because there's two unknowns. Well, actually, you could solve this one. That's something I can solve down here, huh? So, down the bottom, these two. So, solve something for me. What do you do?
Beginning equity is 37.
Yeah, 700 less 330, I can get this 37. I absolutely can get that. Okay, I solved that one. It's not one of the answers, but it's going to lead us there, isn't it? Okay, what else?
The contributed capital beginning has to be 50.
But this has to be 50 at the beginning. Excellent. There's an answer, huh? Beginning contributed capital is 50. If you added 50, you have 100. Yeah. What else? $320. Yeah, she's saying the beginning retained earnings has to be $320 because you know the total is $370 and you know contributed capital is 50. So 50 away from $370 is $320, isn't it? Good. What else can you do?
You can find your ending liabilities.
How can you find your ending liabilities?
Subtract your equity from your assets.
Okay, and what's my equity again?
290,000.
It is. Really? What's my ending equity composed of? What's equity composed of?
Contributed capital, retained earnings.
Add together, right?
What about owner investment? Oh.
Owner's investment is already in there.
Okay.
You add that in twice,
Exactly.
or something.
So it's 240,000.
Well, no, we know 150 is the ending here and 100 is the ending here. 100 is the ending contributed capital with 50 is the retained 250.
But minus dividends.
No, it's already out. Dividends would already be out, right? I'm going to use the dividends to determine what the net income is. I started with 320, I took out 10, which made it 310, and now it's 150. So the ending's 150, okay? Don't take it out twice. Okay? Well, now you can do liabilities, though. You're absolutely right. What's liabilities going to be? 600 less 250 is 350, isn't it? Yeah, they got that one. Good. Okay. Now what? What else do you need, guys? I'd like to know the net income and the expenses, wouldn't it? Can you get the net income somehow?
How much is retained earnings?
Yeah, your retainer starts at 320, right? We took out 10, which made it 310, and now it's 150. What must have happened? Huh? Yeah, which means a debit, right? Which is a what? If you have, it's going to be 160, is it debit? Yeah. 320 less 10 is 310 less 1, netted with the 150 is 160. What is that thing? A debit, the retained earnings. What does that mean?
A net loss.
Yes, it's a net loss. You lost money. Net loss. So this isn't net income. This is net loss, which is a debit, isn't it? How much is that? 160. So if I lost 160 and my revenues are 400, what must my expenses be? 560. Got them all. Okay?
Why'd you put the 160 below the thing, the dividend?
Because it's a debit. I'm putting it on the left side because it's a debit. It's got to be a debit, right? It can be above or below the 10, I don't care. Right? But it's a debit, isn't it? Right? That's why I put it over there. So I started with a 320 credit and I ended up with a 150 credit. What happened? Bunch of debits.
Yeah.
Okay, it was 10 for the dividend and 160 for a net loss. Okay, if retainers increase to be a net income, retainers go down, you must have lost.
Yeah.
That's it. Yeah, yes.
For the beginning, for the contributed capital, would you, if like the number wasn't even in split count, would you invest as $50,000 or?
No. The owner's investment is, this is the contributed capital during the period of the investment. The beginning balance is there. We calculate that. It just happens to be this, they would both fit.
Okay, so the beginning balance would be the ending contributed capital minus the owner's.
Whatever was contributed, yeah. Or if I knew the beginning and the ending, I'd know how much was contributed.
Okay.
Or if I knew the beginning and what was contributed, I'd know the ending. Yeah, you got it. Yeah.
So the. Okay.
All right, let's do this. You guys do the other one, and then we'll work it together, okay? We're doing the quiz 3 and 4, problem 1. So you guys do the second one. Do exactly the same thing, and then we'll work it together, okay? So this was Ernst.
So the beginning contributed capital was 50?
Yeah, we calculated it, right? Backed into it. The ending's 100, you added 50 to it. The beginning must be 50, right? That's all we're doing, okay? You don't really have to lay it out the way we are working the problem, but it just makes it so much easier if you do. You can see it, right? You can do them in your head, but then you do one, and then you have to tie it to the other one, right? So I think a little template works better. So let's do the same thing, and you guys calculate this thing. Plug in, write down everything you know, solve for what you don't know. See how quick you can do it. So you ought to be able to really move. Get points. The better you know it, the faster you can move than just talk about it. Okay, let's give it a shot. What'd you write down?
Everything sounds good.
Yeah, so what? Let's go.
Well, beginning liabilities were 270,
Okay. Put beginning
and
up
the
here.
endings were 300.
Liabilities.
Yeah.
Okay, good. It was too easy to believe. Now what? What else you know?
Revenue was 240.
Okay,
Beginning contributed capital was 200,
beginning.
and then the ending contributed capital was 100,
Okay. What else?
and then there was no revenue.
That was it?
Oh, retained earnings, for the beginning was 160 and for the end was 200.
Okay. Do we have dividends or net income, either one?
Dividends zero.
Dividends is zero. Okay, you need to know that. It's a number, right? Is that everything? What can you solve? I can't get assets, I can't get equity in either one. Oh, but I can get ending equity twice, right? Or beginning and ending equity. What's beginning equity? 200 plus 160, isn't it? Did you do that? What's 360 plus 270 for assets?
630.
Okay, got that one. I can get ending too, can't I? 100 plus 200, what is it? What's your beginning or ending assets? Okay. All right, so now what do I need? What's my contributed capital during the year? They withdrew, didn't they? How much? 100. They bought back stock is what that really is. Okay, sure, I know that. Yeah, that kind of confuses you, huh?
Is that the same thing as owner's investment?
Owner's investment, yeah, but it's a negative investment. They took it out.
Do you actually put the negative?
Yeah, oh, yeah. They took it out. Put brackets around it. Or say withdrew 100, whatever.
So the owner's investment was in negative 100.
Yeah, sure it was. Don't you think? Okay, debit 100. Okay. What else do we get now?
Well, did you get net income?
Oh, sure. We always could get net income, couldn't we? Right? It went up by 40 and we took nothing out. What's net income? 40. And then that's the same net income, of course, on the income statement. So what's expenses, everybody? 200. How long does it take to do this? I don't know, 30 seconds? You know what you're doing, huh? Right? And it's not a trick, you guys. It's knowing what the statements have in. Right? So, good. Fantastic. Everybody get it? Why didn't you say, let's go, Keith? Aren't sure? All right. Number 2. What would be the effect of the year-end financial statements of failing to record an adjusting entry for insurance during the year? March 1st, there's a $3,600 payment for insurance. The payment was made to a deferral, which I even told you is an asset. So they deferred it, right? Into a deferral account, an asset. What would the asset be, of course, if it's for insurance? What was the entry they did on March 1st? Might be helpful to you to just write it down. Yes. It's an asset, isn't it? Deferred asset. Prepaid insurance. Excellent. Okay, that's what it is, right? They prepaid it. It's an asset. They bought it for $3,600, didn't they? Excellent. And what they credit, probably? Yeah, now you didn't have to write this down, but it kind of helps, doesn't it? Because you know you have prepaid insurance at $3,600. What else do you want to know? Well, it was March 1st. What's their year end? Says it's December 31st, so when are you going to make an adjusting entry at December 31st? So what do you want to know? How much time went by? How many months is that? 10, right? Remember, you've got to count March. So January and February were 2, and there's 12 in a year. I think it's 10 months, absolutely. Okay, so I used up 10 months of that. What else do I need to know? How long does the insurance policy go for? How long is it? Oh, it's 2 years. So it's 24 months, huh? So it looks to me, well, like we used 10 out of 24 months, 10/24ths of it. What do you bet? That's it, isn't it? You can divide 24 months into 3,600 and find out what it is per month. What is that? 150. And how many months went by? 10. So you used up 1,500 of it. When you use up an asset, what does it turn into? An expense. And this is insurance that turned into an expense. What do you want to name it, everybody? Insurance expense. Excellent. And what do you want to credit? Sure, because you used it up. How much did we do? 1,500? What's left, you guys? What we have is prepaid insurance.
2,100.
And insurance, 2,100? Oh, what does that represent? Let's see, we're using up how much a month? 150. How many months are left? 14. Oh, what's 14 times 150? 2,100, of course. You bought 3,600. That's that one, right? You used 1,500 of it. It became insurance expense this year. What's going to be left? 2,100, which of course is 14 months at 150.
So we don't have to write down that 2,100 anywhere.
This is all you have to do. If I asked you what the ending balance is in prepaid insurance, you'd have to tell me that, right? You know, if that's the question, you could answer it, couldn't you? But this is all you need to answer that question. So really, right, that's all you really need, because that's the entry that we're talking about. Okay, now this would like to know, are they overstated, understated, or no effect if you don't do this entry? Well, if you know what this entry does, you can obviously say what would happen if they don't do it, right? Okay? So it's getting simple, isn't it? You guys are kind of training your minds a little bit. How many of you have never had an analytical class like this analytic? You know, you have math class. Yes, it's new, isn't it? It's a new way of thinking, right? So it's okay. It develops the left side of your brain. Sorry, analytical skills are really handy. I used to be really good at English and really crummy at math. Now I'm good at both. Why not? Huh? You can train yourself. You can teach yourself. I still don't like formulas. Can you tell I don't like formulas? I convert everything into common sense. I don't like formulas. Still using formulas, of course, right? I just don't write the notation down. Kind of annoying. Unless it's really complex, and then I do, because otherwise the words are way too many. It's simple, just do it like this. Okay, so you can make yourself good at whatever you're not good at. You can even make yourself like it, which is strange, but you can't after you get in and digging into it. Okay, anyway, let's do this. Does this look familiar? Nothing to it. Little model. You tell me what that entry right there would do. Debit insurance expense, what would it do?
Decrease in assets.
Okay, credit prepaid insurance decreases assets by 1,500. I'll buy that.
And then decrease in equity.
It must be a decrease in equity because there's no effect on liabilities. I'd buy that. How do you know it's a decrease in equity? How'd that happen?
Net income's a decrease.
Net income went down by 1,500. Why did it go down?
And then
Because expenses went up. Excellent. What happened to revenues? Nothing. There's no revenue in that journal entry. Nothing happened to it. So now, if I fail to do that, what's wrong? I fail to reduce assets. What's wrong? Overstated. Liabilities are fine. What's wrong? Nothing, right? How about equity? It needs to be less. How about revenue? Seeing as nothing's wrong. No effect. How about expenses? Understated if you fail to do it, right? And then what would that do to your net income? Overstated, which is caused the overstatement. Ta-da. Okay, you guys do the next one, and let's do both of those. And then, by the way, did you notice I made the journal entry, then I looked at what the impact of the entry would be, and then it's easy to do the over-understated. If you skip straight to the over-understated, maybe you can do it. I think I could. I could just read that and say what it is. If you guys can't do that yet, fine. Write it down. It only takes a second. Okay? When you're moving on a quiz, this isn't a very long problem either, really. Okay? It's harder than the first one. But do number 3 and do exactly the same thing, and we'll do the over-under. Finish the whole thing. Do the journal entry, do what impact it has, and do whether it be over-understated if they fail to do it. Okay? So do exactly what we just did there for number 3. See if you can pull that off.
What's per
Per annum means per year, annually. Per annum, per year. If they don't say, you assume it's per year anyway, right? Per annum, or you can just say annually. Annually. That's good though. See, there's a little bit of business terminology for you. Per annum. That's the kind of neat thing about doing well in this class. You learn a lot about business. Accounting is just business. Just business. It's with marketing. Human resources.
On this question at the end, are they hyphenated by the student?
Oh, is it a third person? Doesn't say.
Doesn't say.
Oh, wow. Oh, it doesn't matter because, no, it's just been approved. Oh, you're doing the payment. Assume the payment, it hasn't accrued interest, so just assume the payment is within the year, which it has to be. So it's just the payment, and we accrued nothing last year. So it's all within the current year. So pick a day, it doesn't matter, right? But everything happened this year. That makes sense? So that's what, when it says there was no accrual, that means there was nothing last year. And accrual last year would have been debit expense, that interest payable with. Yeah, so here's going to be all expenses. Because you haven't recorded them. That's what that means. Good question. Sure. Figure out where you're at, where you want to be. Make the entries so you can be where you want to be. And then figure out what happens to the balance sheet income statement. You kind of already know into the entry, right? But still, run through it. What's that?
What's that?
That's the one right before this number.
Oh, okay.
What we need to do on this thing is record the payment, right? You're going to pay the debt, and you're going to pay the interest on it, aren't you?
So you're getting paid.
Yeah. Oh, it's the other way around. Oh, well, then it's a note receivable. So it's interest revenue instead of interest expense. Yeah. Would have been interest receivable if you had accrued it, but you did not.
Oh, okay. So it's not.
No, there's no interest receivable because it hasn't been recorded. The note's receivable. And there's going to be interest revenue. I'm sorry. And you're receiving cash. Yeah. Read the question. I worked it just the other day, too. You'd think I could remember that one. It's just sort of a mirror image of if it was a payable, isn't it? No receivable. One has a note. One company has no receivable. The other one has a note payable. One has interest revenue. The one with the receivable. One has interest expense. Right? One gives up the cash. One gets the cash.
Didn't you have it for that? No, I have a practice test.
Oh, you're working on the practice test. Oh,
Yeah.
okay. No, you couldn't find the question. Yeah.
I'm so confused because it's talking about insurance and the other one's talking about a truck.
Yeah. So how are you doing, guys? Got it?
Everything but the over.
Well, if you can do the journal entry, and you know whether it would increase or decrease each of the accounts, right?
Well, yeah, but
Then you kind of automatically know it's just the other direction. If there's no effect, it's no effect. If your entry would increase it and you don't do it, it must be what? Understated. If it would decrease it and you don't record it, it's overstated.
aren't you're gaining and losing an asset?
Yeah, both. So you take the difference between them, wouldn't you? You're receiving an asset, cash. You're giving up an asset, notes receivable. Yeah, so you just take the difference between them. Okay, so what happened here, you guys? They're paying us in full on a $10,000 note plus 9% interest, but it's only 6 months. So it's 4.5%. About 10,000, or 9% 9% times 10,000, which is 900 divided by 2 for half a year, right? 6/12 of it.
So it's telling us that the 6 months is the time that's gone by.
Yeah.
Okay.
Borrow the money for 6 months. Yeah. So what do we do? It was a 6-month note. So what did we get?
I'm at 415 as well. We got 450 more assets than we had before.
Yeah. So give me the journal entry. Debit cash, right?
Yeah.
How much?
10,000 more than 50.
Sure. And credit what?
Don't you see full interest revenue?
Yeah. So the note receivable he's saying is 10,000. So we got 450 more asset that we gave up. Yeah, I agree. Okay, you don't have to write it down. It's okay. But if you do, you can't screw it. Right? And then what? Interest what?
Revenue.
Yeah, we earned it, so it's interest revenue. We're going to hit our income statement for 450. So if you know that, that's what they need to record, right? So all this question's asking is what impact would that have? You already know when you record it, don't you? That's the whole
Okay, so
point.
doing overstated, understated, that's why I was confused.
Well, we'll do that.
Okay.
The question here only asks for increase and decrease. Right? So you have to look at what the question's asking for, obviously. Okay, but it says increase, decrease, no effect.
Yeah.
Okay, what happened to assets? Cash up, note receivable down. You could write them both down if you want. 10,450, more asset for the cash, right? Less asset for the note receivable. But what's the net effect on assets? More by 450. So I'd say increase 450, wouldn't you? Okay. What about liabilities? I don't see a liability in that entry. Nothing. What must be the case with equity, seeing as the two have to add up, or the assets have to equal the other side.
Goes up to 450.
This is nothing. So this must go up by 450. We already know that, don't we? How'd that happen? Oh, it's got to be net income went up by 450, doesn't it? Because there's no direct effect on equity. So if equity goes up by 450, it must be that we have net income, more net income by 450. How'd that happen? Revenue, yeah. You have 450 more revenue. What happened to expenses? Nothing. And of course, that gave us more net income, which gave us more equity. Boom. You're there, huh? Now, if you do that, now let's convert it to overstated, understated. What would you do? If you fail to increase your assets, understated. If your liabilities are okay, no effect, obviously, right? Okay, equity would be understated. It's got to be the same on both sides of this, doesn't it? Yeah, total revenue, understated. Expenses, no effect. Net income, understated. Good. We got it. You want to do one more of those? You guys are a little fuzzy on that. You want to do one more?
Yeah.
That'll be worthwhile. Okay, let's say, do this. On January 1st, I bought a building for $110,000. A little tiny building, I guess. Okay? It's going to have a life of 10 years, and then it's going to have a salvage value of $10,000. And I'm going to use straight line depreciation, which means the same amount every year for the 10 years. And I'm holding it for a whole year to make our life easy. Okay. What I'd like you to do is give me the adjusting journal entry that's necessary at the end of the year. Tell me what impact that does, just like those two questions, increase, decrease, and then give me over or understated if you fail to record it. What's the journal entry to record that? Well, first, what's the journal entry for this? Oh, let's say I put $20,000 down payment.
Like cash on our account.
Cash is down.
Okay.
Down payment's cash.
Okay.
And then I signed a note for the rest. I didn't ask for interest. You want to do interest too? We could add that.
Does that say life thing what?
10 years. 10-year life. 10,000 salvage. Bought it for 110. 20,000 down. The rest I signed a note for, of course. Give me the entry for that. First, what's that journal entry? What is this journal entry going to be? For doing that transaction. Can you do that? It's easy. I got a building, but it's not an expense. Did you use the building up? No, we have the building. What is it? It's not an expense. What is it? It's an asset. Yes. And what did I give them? Cash, which is an asset. And what else did I give them? Note payable, which is a liability, and I have more of it. Come on, you guys. Put all the thinking together. You're getting really close, I can tell. All of you are. You're still swimming, but you're getting close, aren't you? Get it solid. Get it solid. Okay? Everything that you know how to do when you go to work, you want to really know it. You don't want to have a vague idea. Right? We don't keep people with vague ideas. We keep people who get stuff done. Right? It doesn't mean you have to know everything when you go to work. Be happy to train you once. Got it? Happy to add to your toolkit. Oh, you don't know that? Okay, here. Right? They'll show you how. You don't want to ask them again. Right? I mean, you do if you have to, of course. If it's real complex, you do. And then they can make fun of you. It's entertaining. Right? So, you know, you can say, well, it's good. Let's go have lunch, and you can explain this to me again, and I'll buy you lunch, because you already explained it once. They'll laugh at you. They'll go to lunch with you and buy you your lunch and show you how to do it, too. They have money, you don't. It's going to be fine, right? But at least you tried. So, anyway, all right. Mostly write down what they show you. Well, write a journal. What do you mean, what would you label it? You mean the building?
Yeah.
Oh, I got a clever name for building. Building. Okay? I'd label it that, wouldn't you? Would you call your buildings buildings in your balance sheet? Yes, sir. Okay. I might have a whole bunch of buildings. So, you know, it's buildings, right? Think how many buildings General Motors owns, GE owns. Guess what they call it on their balance sheet? Cleverly. Buildings, right? Okay, good. How much is the building? What do we pay for it? 110. At least we will eventually. What do we give them? Cash. You want to credit it? Yeah, you guys know that, don't you? Don't get frustrated. It doesn't do any good. I said don't get frustrated. It doesn't do any good. Getting mad's really good. You're frustrated because you didn't have the answer.
No. I had it written down, but I wrote expense instead of just, I wrote building expense.
You understand why it's not an expense, don't you? You did not use it up. Besides, it's not going to be building expense. It's going to be what as I use it up? Use of its utility value. What do I call that? Depreciating the building. It's going to be depreciation expense. Got it? Okay. If I use up prepaid rent, though, what's that going to be? Rent expense. Yes. Okay, got it? So it's just getting your head straight on it. Good, fine. Okay, then
you don't do the notes payable for like 90?
oh, I do too. Don't your debits equal your credits? Yeah. Debit 110, credit 110. We're good. So exactly, what's the note payable? A liability. How do you increase liabilities? With a credit. Yes. So this is going to be notes payable. Very good. That's fantastic. You're exactly right. Was it driving you nuts the debits didn't equal the credits? I hope so. That's good. That's what you want. You know, no. They have to equal each other, right? And you're there. So you know when you're done, right? I'm okay now. Okay? Good. I'm just real slow. Okay? Talk too much. In real life, how long would it take me to write that journal? Oh, a few seconds. Right? Boom. You know what you're doing, right? Okay. And we just changed the financial statements, didn't we? We just increased assets by how much? Up by 110? Yeah, let's do it. What did that do? That first transaction, what did it do if I asked you for that? Assets would go up by 100,000 for the building. What else happened?
Cash would go down by 20.
Which is I credited it though. Cash is, there are only assets, liabilities. There's assets, liabilities, equity, revenue, expense. That's an asset. So you increased one asset by 110, you reduced another one by 20, didn't you?
Yeah.
What happened to assets? They went up by 90. So that's what I'd say. Wouldn't you guys?
Yeah, but you wrote up on.
Yeah, why'd you write up? You mentioned you were at 110 there, right?
Yes, I did. Thank you. 110. Okay. Yeah. They went up by 110, right? And then down by 20. The net is 90 increase. Absolutely, that's what happened. What's the notes payable? Liability went up by 90. Does 90 equal 90? Yes. What happened to equity? Nothing. There's no equity account there, no revenue expense account, which are temporary equity accounts, right? And nothing to revenues, nothing to expenses, nothing to net income. Easy, huh? Okay, do the adjusting journal entry at the end of the year. What would it be? What are we going to do with this? We're using this building for a full year, you guys. So how do we reflect using it up? It's depreciation. Good. Okay? You guys are starting to work hard, aren't you? This group kind of took a while. But you're getting there, aren't you now? Going for it. That's all it takes. Understand one piece, then the next piece, then the next piece, then the next piece. It all start fitting together. It's a whole knowledge set, okay? So way to go. And just dig in and do it. You're going to do it someday anyway. You're going to do it the last week before the final so that you can get a C. Or you can do it now and have an A or a B. You're going to spend the same time either way. What do you think? What would be a better strategy? Good. Besides, you're going to be far busier than you are now. I mean, you might not think that, but you did do last semester, right? So you guys know. You know what happens at the end. All hell breaks loose, falls apart on you, right? Let's not do that. Do it now. Okay, so drives me crazy. By the way, I'm not nearly as responsible as I want you to be. That's why I'm poor. Okay. Yeah, okay. Anyway. Clearly. So what's your entry? Go ahead. Are you computing? First, what's the debit? What's the credit? Let's do that first.
Accumulated depreciation for debit would be the debit.
You're going to debit it. What kind of account is accumulated depreciation? It's a contra asset. You're reducing assets. So what would you do? Credit that, wouldn't you? Yeah, I think so. This reflects the portion of the asset you used up. But that's good. He had the guts to say something. It's credit accumulated depreciation. Debit what? You're depreciating this. We're using it up. It's called a what? Expense and depreciation expense. So you debit the depreciation expense because it's an expense and you have more. It reflects using it up. And you credit accumulated depreciation because that's the portion of the asset you've used up. So I'm going to show building less accumulated depreciation on my balance sheet. Got it? Okay, so you're on track. All right, how much is all you have to know? Would you get 10,000? What'd you do? Cost of the building is how much? 110?
110 minus 10,000.
The salvage value or residual value, what we're going to sell the building for when we use it up is 10, right? The land's separate, you guys, right? The land underneath is separate, accounted for separately. Okay, I'm not saying you sell the land plus the building, right? Yeah, okay. The land might be another 100,000. It might be worth even more by the time you sell, right? Okay, so anyway, but what's the depreciable value then of this thing? 100, right? And how many years was it? The life. 10 years. So what did he get? 10,000 depreciation every year. This was a whole year, right? It was half a year. We used 5,000. It's a whole year, wasn't it? So it's 10. So isn't it debit depreciation expense 10,000 and credit accumulated depreciation 10,000? Can you tell me what impact that would have on the accounting equation? What does that do? What does that do on your financials? Yeah. Yeah, it looks like your assets went down by 10. So all we do is we say assets equal liabilities plus equity, revenues less expenses, net income. All right, good. The assets go down by 10? I agree. What else happened?
Equity goes down.
That's this one. Equity goes up? No, I think equity goes down by 10. Is that what you said? No liabilities in there, right? So these two sides equal each other. I'm happy. Okay, what about revenues? No revenue there. Nothing. Expenses? Up by 10, which caused net income to go down by 10, which caused the equity to be 10 less. Boom. Okay, now, so the hard part is getting the journal entry, isn't it? Every time. Concentrate on that, and then the rest just work through it. Okay, relax. Do it. Okay, what if I fail to do this?
Assets
Overstated, no effect. Overstated, no effect. Understated, overstated, which caused the overstated equity. Boom. Okay, let's do something else. You guys are getting it, aren't you? So think of all those different journal entries. All the entries that I give you on number 5 here, anyone's fair game in it for doing that over-under stuff. So not a big deal. Okay. We don't really have to do 4, do we?
4.
Wouldn't you love that? No. Rent expense, expenses. Debit. It's increase. Accumulated depreciation. Contra asset. Credit. Unearned revenue. Liability. Credit. You have to know what they are, don't you? That's what's kind of tested. Prepaid salaries. Asset. Debit. Yeah. All right. So let's do number 5. And these start getting hairy after a while. Exactly. What's that?
Isn't the one we just did with the building, isn't that the same thing as number 5, just with the, rate on?
Yeah, except the piece of equipment in 6 months. Absolutely. It's exactly the same thing. Oh, it's easy, isn't it? It's just easy. All right, number 5. Okay. Here we go. Purchase equipment for $35,000. What do you think you got? Equipment. That's an asset, isn't it? What do you do to it? Debit it. No. What do we give them? What's that? An asset. You have less. What are you going to do? Credit, of course. What else did you give them?
No.
Your promise to pay. That's a note what? Payable, which is a liability, and you have more. What do you do to it? $25,000. Ta-da! We're done. The first one's done, isn't it? Okay, what about the interest? That's when we do the interest expense. No time went by, there's no interest expense, right? There's no interest payable, no time went by. If time goes by, what's going to happen? You have interest expense every single day, really, right? Probably every single second, I suppose. You owe them more, whatever. Okay, but certainly every day I'd owe them more. Every month I'd owe them more. But if I'm not doing financial statements, who cares? I'm not going to record it until I do a financial statement, or I make the payment, right? True? Everybody good? So I'm going to do nothing with the interest. How about depreciation? Same thing. Every day there's some depreciation, but I'm not doing a financial statement every day. So when do I do depreciation expense? Whenever I do a financial statement. If I'm doing monthly, I'll make a monthly journal entry for it. Debit depreciation expense, credit accumulated depreciation for 1 month. 1 month's worth, the dollar amount. What if I'm doing it quarterly? Every 3 months. What if I'm doing it annually? Once a year. Got it? Nobody does annual, really, but except for principles classes, we try to keep simple. Try to keep it simple, so we do annual. Yeah.
So we're doing these by the date next to them, not as it is December 31st?
Oh, yeah. January 31st. That's when we bought it. So when we do interest, it's going to be based on January 31st forward, right? When we do payments, it's going to be 6 months from that date, right? When we do depreciation, it's going to be from that date, because that's how long you borrowed the money and how long you had the asset. Got it? So it's whatever happened. Okay, March 1st is the next thing, right? What happened? We purchased supplies for $2,000 cash. What do you want to do? Okay, they get 2 ways to do this. Yes, ma'am.
Wait, so now, so we're doing a balance sheet right now, but then for the income statement?
No, we're going to do the balance sheet and the income statement on the same day, which is going to be December 31st in this case. Whatever their year end is, they're going to do them both at the same time at the end. Yes.
Okay.
The reason we debited equipment is because we have the equipment now.
Okay.
The reason we credited cash is we gave up the cash now. The reason we credit the notes payable is we have the notes payable now, as of January 31st. See it?
Okay. Okay.
Right? So I have to record what happened now if there's a transaction.
Right.
But in terms of making the adjusting journal entries, I'll wait until I do financial statements.
Okay.
Does that make sense?
Yeah.
Yeah. So if cash is coming in or out, I have to do that. If I pay payroll, I have to do that.
Okay.
If inventory gets delivered to me, I have to record it, right? Okay, got it?
Yeah.
Or if I sell something, I record the sale. Okay, so that'll help. Okay? All right. So then what happens in March 1st? I purchase supplies. So what do you want to do? Debit what? Supplies inventory, or it could be supplies expense if you want, but I think I can go to supplies inventory. It doesn't say which way to do it, so that's fine. Either one's fine, but it'll change your adjusting entry later if you go to supplies expense, right? Yes. Because now you have to reduce the expense because you didn't use them all. If you put it in supplies inventory, you'll reduce the supplies inventory for whatever you used. Okay, and credit what? I paid for these cash. What if I bought them on account? The account's payable. Yeah, payable for me. They have a receivable and a sale, right? Okay, good. All right, and then it says how many are on hand, but I don't need to worry about that until when? I compute how much I used and record supplies expense, right guys? Reduce the inventory. So we'll worry about that later. Let's do C. Paid rent for March of $3,000. It's March, and this is the month of March. It's March 31st. This was March 1st. I should put the dates, yes. Come on, Steve. 3/1. This is 3/31. Okay, you paid this month's rent. What is it if I used it up? Expense. Yes. You guys are getting there, aren't you? Debit rent expense. Whatever the expense is, salary expense, rental expense. I guess that was it. Interest expense. Pick something. Utility expense. All kinds of stuff, right? How many expenses does business have? Business has thousands. And if you use something up, it's an expense, okay? So how much?
3,000.
3,000. What do we give them?
Cash.
Cash. What if we were going to pay them later?
Accounts payable.
We'd probably call it rent payable. Yeah, the rent payable, and you kind of get used to, right? Rent payable, right, on these accruals. What if I had paid it last month? What would I have done last month? Debit prepaid rent and credit cash. And now what would I do when I use it up? Credit prepaid rent and debit. Rent expense. Yeah, that's it. That would have been a deferral. If I credit rent payable, it would be an accrual. This is a cash transaction. You got them all done. Okay? Keep working, keep pounding on it. And relax. Okay? The biggest thing. After you start working really hard, then relax. And you'll relax more if you're really well prepared. It's amazing. You walk in on a quiz or a test and you know how to do everything, you get really relaxed. Right? No big deal. So don't spend any time stressed, it's just work. Okay, D. April 30th. Okay, good. Provided advertising services to clients, 130,000 total, 80 on account. The rest we got cash for. So what do you want to do? What do we get? Account receivable. I like it. How much? It's an asset. More. Debit it for 80. What else do we get? Cash. It's an asset. More. Debit. What do you do? 50? It's 130 total. What's the 130 seeing as I earned it? Advertising revenue. Fantastic. Okay? Would it make any difference if it was, I don't know, rent revenue, and I credit rent revenue 130 and debit rent receivable 80 and debit cash 50? 50 if my tenants paid me and 80 is going to pay me later? Wouldn't matter, would it? How about if some of it had been unearned revenue? They paid me in advance and now I'm earning it. Could I credit advertising revenue and debit unearned revenue? Sure, we could do that. We will later, won't we? Okay? That one would have, this one's an accrual of revenue, right? The 80 is. It'd be a deferral if it was unearned revenue, wouldn't it? Yes, sir.
There's just service revenue that we're getting.
Yeah. Probably call it advertising service revenue. But advertising revenue, service revenue, advertising service revenue, I'll take them all. Don't call it sales because we didn't sell them goods. Sold service. Okay. Good question. Are we good? Good. Could we do increase and decrease and overstated and understated on any single one of these entries? Yes. Yes. No big deal. All right. E. May 30th. May 30th. May 30th. I guess I thought there were 30 days in May or something. So it could be sometime. It could be any day. I guess I didn't screw it up. We received 60,000 from clients that we previously did work on a credit basis for. They're paying us off some of the. We had a receivable, they paid us, right? So what do you want to do? Debit accounts receivable? It's an asset. I think debit cash. We have more as cash, which is an asset. We're getting the cash. And what don't we have anymore? Their promise to pay us is gone. So we have that account receivable go away. And how do you reduce an asset named accounts receivable? With a credit. Okay, yes, that's it. Okay? We decided to deal over here. Okay? F. Second would be paid insurance of $6,000 for a year starting July 1st. So this is June 30th. It's for the coming year, isn't it? What do we give them? 6,000 of. Oh, I have prepaid insurance. That's what I bought, but that's not what I gave you. So that's an asset, right? Debit prepaid insurance. Would you guys agree with that? Increasing that asset by 6,000. You can go to insurance expense if you want, but if you do, what's going to happen? You'll have a different adjusting entry later, right? So then you'd be reducing insurance expense and increasing prepaid. It's going to be the reverse if you do it this way. Okay? And credit what? What do we give them? Cash, of course. We have less of that asset. Think how fast you can get on each, you guys. And you really don't have them memorized, do you? Because they're going to change the names of the accounts, so what? To the other account. Doesn't matter what it is. There's all kinds of prepaids, all kinds of expenses, all kinds of accrued liabilities, right? all kinds of unearned revenue, all kinds of revenue, all kinds of receivables. So, what, we don't care. What's G? Made the first payment. Okay, now this one gets hard. By the way, I'm paying off some of the note, right? Tell me what the deficit and credit's going to be. What the, not the dollar amount. What's the deficit and credit's going to be? What am I going to give them? Yeah, so are you going to credit cash? It's a good idea to write down what it's going to be and then figure out the amount. I think it might help. What are we paying off? The note payable goes away. So we're giving them cash. The note payable goes away. This is at July 31st. Yeah, that's the first one, isn't it? Because it's 6 months from the January 31st when we borrowed them. And what else are we going to have to pay them? Of course, we're going to pay them interest, aren't we? Right? It's going to be interest expense. Because we know we haven't accrued any interest. We didn't make a journal entry. Accrued means debit interest expense, credit interest payable. Okay, how much did we borrow? You guys remember? How much did we borrow? 25,000. That's the note payable, right? So we're making a payment against that. You guys agree? So it's only 6 months, so it's 25,000. What was the interest rate if you go back and look at that one? 6%. 6%, but that would be for a what? Year. What portion of a year do we have? January 31st to July 31st. Half a year. 6/12 of a year. 6 months. So how much is that? 3% times 25,000. 750? Is that right? 750. 1,500 for a year, 750 for half a year. So how much are we paying them? We're paying off how much of the note, you guys? It was half of it, right? 12,500. What do you want a debit notes payable for if you're paying off half the note? About 12,500. That's it, right? How much cash are you going to be giving them? 12,500 plus 750 of interest, right, guys? 13,250. So how much interest was there? It's 750. What's that? Interest expense. Even I could do these. Easy, huh? What does that do to the accounting equation? Could you do that one? Let's do that. What's the impact of doing this? And what would be the impact of not doing it? It's a little more difficult because there's three, huh? 3 accounts. One's a liability, one's an asset, one's an expense. But do it, you guys. Look how fast you can do this. Is it easy? You just got to click switch the thing.
So do your assets, since you're giving the cash away, your assets decrease?
Yes.
Cash is an asset.
Yeah, less asset by 13,250. I think so. Why do you guys always say lose it or give it away? I did give it to them, but I'm paying for something. Yeah, that's true. You are giving it away, giving your cash away. I wish my wife would thought that when she goes to the store and buys crap. We were wandering down the street yesterday, day before yesterday. She walked into a store and just bought a ring, just like that. Holy crap. I'd have to think about that forever. It was cheap. Jeez. I could have had a case of really, not 2 cases, really good beer. I could have had a nice bottle of bourbon. A good, not a great bottle, but a really good bottle. It was pretty cheap. Yeah, stainless steel and some kind of stone on it. So it wasn't silver, it wasn't backwards. That's for sure. Okay, anyway, that's good. And it was real pretty. I thought it was much prettier than it was a diamond. Diamonds cost thousands. Yeah, so, okay, stay away from those things. Okay, anyway, so what's this? Cash is an asset. It's less by 13,250. Did you guys say that?
Yeah.
What else do you have?
Liabilities.
Less liabilities by 12.5. What must be the case for equity? Down by how much? 750, because you got to add 750 to 12.5 to get 13,250, of course. So what are we missing? We got this, we got this. That one, huh? Expense goes up by 750. What do you think happened to revenues? Nothing, right? Net income?
Goes down.
Down by 750, which of course is what caused the equity to go down by 750. You're not gonna miss these, are you guys? Just relax. Do it, okay? FG H is next. Like that, October 4th, what happened? Oh, by the way, after we made that payment, how much do we owe them? You know, if you owed them 25, you paid them 12.5, what do you owe them? 12.5, what are you gonna have interest on next time? On the 12.5, right? Not a whole 25, you paid half of it, right? Good. Okay, October 4th, received advance payment of 40,000 for advertising services we're gonna deliver over the next 6 months. What's the journal entry? What do we get? Cash. It's an asset. You have more. You debit it. Credit what? Unearned revenue, because we haven't earned it yet. What kind of an account is that? A liability. Unearned advertising revenue? Something like that. Unearned service revenue. Okay, right, guys? And we got it. What happened? I increased assets, I increased liabilities. Nothing else. What will I do when I earn this? Debit. Unearned revenue and credit. Advertising revenue, because I earned it. Yeah. This is a deferral, right? Deferral of revenue. Good. Okay, now we get to December 31st. Oh, well, that one's an easy one. We got employees who earned 35,000, it hasn't been paid or recorded. So they did the work for us this year, but we haven't paid it yet. So what should we do because they did the work this year? It's salary expense because we used it up. Yeah, salary expense, wage expense, something like that. And what would you credit? Salaries payable. Yeah, don't put the word expense in. Salaries payable. 35,000. What are we going to do when we pay it? I'll credit cash. Won't you? What will you debit? Salaries payable. Yeah, of course, the liability goes away. What is that, an accrual or a deferral of that expense? That's an accrual. What would be a deferral of expense? A prepaid. Right? What's an account receivable? An accrual of revenue. What's unearned revenue? Deferral of revenue. Okay? Okay. Good. J. Counted the supplies on hand and computed their cost to be 700. Okay, what did we have with supplies before? They told us the beginning balance, didn't they?
Yeah.
And then we bought 2,000. So we bought 2,000 and added them to the beginning balance. You guys agree with that? Okay. We debited supplies inventory for 2,000. So if I have supplies inventory and I debited it for 2,000, and what did I start at? What did they say? Go back to.
Yeah.
You see it?
Yes.
Okay. How much do we have to start with? Yeah. So I have in my storeroom 500, and then I put in my storeroom 2,000 more, and then I take it out, right? And what I'm taking out is going to cease to be inventory and become what? Use them up, yeah, supplies expense. Why do I have supplies? I don't love to have pencils and paper, come on, you guys, right? Or with nuts and bolts or whatever this is, cleaning supplies, right? I don't want to have supplies, I want revenue. Why do I have supplies? So I can use them generating revenue. So I always think about that way, okay? Same with why do I have the building? I don't want the building, I want the revenues, right? But I really want their cash. If I earn the revenues, they'll give me their cash, right? Okay, so I have 2,500 on hand. Then we go count the supplies we have available. How much? 700? You know what it was? So I have 200 more than I started with. What do you think the expense probably is? If you had 2,500 and 700 left at the end, what don't you have? 1,800, just like that. So what do you want to do to supplies inventory if 1,800 are gone? It's an asset and you have less. What do? Credit it. Supplies inventory goes down by 1,800 and what, whoops, 1,800. And what are you then going to credit? Supplies expense. Ta-da. Because we used it up, generating revenues, or at least trying to. Easy? Okay. We're good? Good. Okay, let's mess with your heads just for a second. What if instead of debiting supplies inventory, I had done this, and this would be just fine. This would be an or. What if you said, oh, it's supplies. They're going to use it sometime, right? So let's just debit supplies expense instead. Would this be okay? I didn't tell you how to do it, did I? So would this have been fine? Of course it would, right? That would be fine, except now your adjusting entry is going to be different, right? How do I know that? Because you got 2,000 supplies expense. Recorded, don't you? So now let's go down to this entry. Okay, this is the next step to kind of get your head around this. If that were the case, let's do or, what would it look like? What would we do, you guys? I would have supplies inventory with what in it? What was left from last month? 500, right? I would have supplies expense with how much in it? 2,000. And where do I want to be if I have 2,500 in supplies, right? And I still have 700 left on hand. What account do I want to be 700? Supplies inventory, of course. How do I get from 500 up to 700? Debit it for 200, of course. And if I did not use them, where should they come out of? Supplies expense. And what do you have in supplies expense now? 1,800. Do those numbers sound familiar to you? Supplies expense, supplies inventory, it's the same, isn't it? It'd be a different entry because of how you recorded the supplies when you bought it. Start to get your head around that? Make them swim after your head swim after a while. After a couple hours of this, you can't understand anything. Yeah.
Yeah, so I have a question. So on the left side is when you'll always add everything up.
No. Debits go on the left, credits go on the right. You
like,
add up both sides and take the difference between them. Okay? So this debit plus this debit here plus that debit is 2,500. Less this credit of 800 is a 700 debit.
Okay.
But if it's a liability account, let's say accounts payable, it'll have a normal credit balance, right? Let's say I owed 10,000, right, to my vendors. And then I buy another 100 from them. I owe them 110. And then I pay them 90. Now I owe them 20. So I'm adding up the credits and adding up the debits and taking the difference between them, right?
Yeah.
So you don't have to remember which ones to add and which ones to subtract. And besides that, debits increase assets and expenses. Credits increase liabilities, equity, and revenues. You'll go insane trying to do anything to the left or right. Okay, don't go there. Okay, you don't have to remember which ones to add and subtract. If I have a net credit, I have a net credit. What if I overpaid? What if I overpaid? This might help make that clear. Let's say I started with 10, right? I borrowed, what did I say? I borrowed 100. So I got 110 I owed him. What if I make a mistake and pay 115? You suppose that ever happens to anybody?
Yes.
Sure. You overpaid the thing, right? Oh, it happens. Yeah, there you go. And what do you got? You got a 5,000 debit in accounts payable. What does that mean? You owe your vendor 5,000. If they only owed you 110 and they paid you 115, don't you owe them 5? And now, the other way around. They owe you 5. You overpaid them 5, right? So now they owe you 5, right? Isn't that really a receivable, not a payable? It's a receivable from your vendor. Weird, right? But probably what you'll do is next time you bill them something, you'll just offset that again.
Yeah.
If it's a whole bunch, though, they might want a check for it. You'll actually send them a check. And if you send them a check, you would credit accounts payable. If they sent you a check, you want a check from them, right? If it's a big amount, you wanted to refund it. And then what you do is you credit accounts payable for the 5 and debit cash for the 5. Does that help? We're just keeping track of where we're at. That's all we're doing. Now, typically, accounts payable is going to be a what? Credit, of course, right? Because we try not to overpay. Yeah, okay? But it can happen. If a customer overpays you, you don't have a receivable anymore, what do you have? You owe them the money back. What is it? Suddenly a payable. What if you withdraw too much money out of your bank account? This one's awful. So what if you take more money out than you have in it? You can go to jail if you did it on purpose, that's true. But yeah, what's the deal? You have an account payable to the bank. You owe the bank, right? Bank overdraft is a payable to the bank. It's a liability. Okay, anyway, so what would this entry have been? Debit supplies inventory this time to increase it by 200, and credit supplies expense to reduce it by the 200. And we'd be just fine. We end up at the same place. That was this, and that's right. That do it? Easy, huh? Easier. Okay. It's a good way to spend your afternoon, you guys. Not particularly mine, because I already know how to do this, but for you it's probably a great idea. Okay, that was Jay, huh? Hey. completed 25,000 of the work we did in the H above. Where did we put it when we did the work, when we got the money? Unearned revenue. What are we going to do now? Earn it. So what happens? Debit the unearned service revenue, whatever it was. What was it? Advertising?
Yeah.
Same account. For how much?
25,000.
25,000. Okay. And credit what? Since we earned it.
That's six, right?
Advertising revenue. And we got it, you guys. 25,000. Okay? Good deal? We're happy, huh? Okay. Okay. L. These are all at December 31st, I think. Do we need an entry relating to the insurance? What do we have on the insurance? And I won't do it both ways. Spending a lot of time. If I put into prepaid, the 6,000, how long a period of time was that for? On F? 1 year. And it starts July 1st. How much time went by the end of the year? December 31st? 6 months. So how much of it did we use up? Half of it, 3,000. What do you want to do? Debit what? Not debit, prepaid. I credit prepaid insurance because we're using it up, right? Have less assets. What does it become? Insurance expense. How do you increase expenses, guys? With debits. How do you reduce assets? With credits. That worked pretty good, didn't it? Okay, good. We're there. Okay, M. These are a little tougher. What do you do on the debt? How much do we still owe? We said 12,500, right?
Yeah.
What's the interest rate per year?
6%.
6%. So it's not going to be 25,000 times 6%. It's going to be 12,500 times 6%, isn't it? You guys agree with that? Okay.
What would it be?
How long? When was the last payment made? July 31st. How much time between July and December? This is now December 31st. This was mean. It's not 6 months. It's August, September, October, November, December. It's only 5. Almost everybody misses this when I give questions like that. Because you're thinking about everything and it's 6 months. No, it's not. It's 5. So it's not going to be 6% times 12,005. That's 750, right? And you divide it in half. It's half a year, 375. That's the common answer people give me. Or they'll do 25,000 again, right? I'm not going to pay interest on something I paid off. Are you? Hold on. Just let yourself think about it. So what do we get? How much is that? 312.50, is it?
Yeah.
Is that what it was? Yeah. Is there going to be another month's interest on this? It's 1 year. Yeah, but it's next year. It's in the following year, right? It's in January. So what do? I have this much interest that I owe that I have not paid. Time's gone by. I have incurred interest what? Time goes by. I got to use the money. The cost of using the money is interest. It's interest expense, yeah. It's more interest expense by how much? 312.50. And then what? Interest payable because I owe it. Absolutely. Okay, good. I didn't ask for this, but let's do it anyway. What would it be at January 31st when they pay it? Okay? Problem didn't ask for this, but if I did, what would they do when they pay it? What are they going to pay on January 31st? Well, it's 6 months. 6 months, right? They're going to pay all 6 months, though. So there's going to be one more month. So it's going to be 12.5 times 6% times 6/12, right? That'd be half a year. How much would that be for interest? Half of 750, right? Because we calculated 25,000 at 6%. So 12.5 at 6% would be half that. It's 375, isn't it? What's the difference between the 375 interest we're going to pay and the 312 that we accrued back here? That's an accrual. 6250, which is January's interest, right? Got to have January's interest. So how much note payable goes away, gang? 12,500. The last 12.5's gone. Because remember that earlier journal entry, we had 12,500 too, didn't we? credit it for 25, and then we debit it for 12.5, and now we're debiting another 12.5. We paid off the debt, haven't we? What else are you going to pay off? Well, the interest payable goes away, doesn't it? I'm paying it. Yeah. So this takes a bit more thought. $312.50. But I'm going to pay them more than that. How much cash am I giving? $375 for interest and $12.5 for principal, right? How much is that? $875. What do I need to make this journal entry balance? Debits have to equal credits. What? How much was it? 1 month. The difference between those two. That's $62.50. 375 divided by 6, right? It's just 1 month, right? Isn't that right? 62.50. What do you call that? Interest for January, what would it be? I used it up in January, you guys. Trying to generate revenues. And it's interest expense. You know what? This interest expense plus that interest expense is the $375. The $312.50 here was interest last year. The $62.50 is interest this year. The $750 in the earlier journal entry was interest last year too, right? In the first year. True, isn't it? Okay. Just gets in the period you want it in. So that's why we do accruals and deferrals to get the revenue expense in the right period. But they get a little more complex as time goes on. Okay. By the way, getting those last two right is the difference between an A and an A minus. Right? Probably could get an A without getting those right. But you need to get questions like that right to get yourself into that category. Okay? Yeah. Do we need, every once in a while at least, do we need an entry related to the equipment above? What do you think? Of course, you have to depreciate it. What did you buy the equipment for? Cost. What was it? 35,000. Is there a salvage value? 2,000. How much are you going to depreciate? Depreciable value over its life, because we want to leave 2 in book value at the end when we sell it off way at the end. So what's the depreciable value? 33,000. Excellent. What's the life of this thing? 6 years. Okay, so if it was full years, it'd be 6 years, right? So how much per year depreciation expense? 5,500. And by the way, this is straight line depreciation. We'll have different methods later. Oh, but it's 11 months. Yeah. Because when are we doing this? At December 31st. And when did we buy it, guys? January 31st. How many months went by? 11 months. You guys agree with that? That made this really hard. Almost everybody misses it. They'll give me the 5,500 if they got that far. And I'll say, yeah, haha, it's fine. Okay, anyway, so 5,500 times what? 11 12s. So what's that? You divide by 12, take it times 11, what do you get? 5042, kind of, right? Pennies. Okay, so double what? Yeah, because I'm using it up, and I am using it to generate revenues. At least we hope so. Trying to generate revenues with that piece of equipment, right? And what do you credit? You don't credit the equipment because the equipment is not going away. Its usefulness going away. Its utility value. Its useful life is. Credit what? Accumulated depreciation. And what kind of an account is that? Contra asset. Oh, I got it. And you guys are slow. Okay, but anyway. Good? Is it getting easier? No, maybe not. Maybe a little easier. So, you know what? Let's call up the answers to, you guys got a few more minutes?
Yeah.
3 more minutes? I know you're getting tired. I'm sure you're tired. You did the comprehensive problem 4.2, did you? Did you look at the answers to it? How many have done it? 4.2. Haven't done it yet? No, you guys have worked it. I really recommend it before you do the quiz. When's the quiz? Yeah, so I guess you got time. You know, you guys don't need to sleep. You're young. You can destroy your health. We all did. You can't be successful without destroying your health. I'm sure that it was that I worked so hard that made me old. Not eating and drinking, all that. Having fun. That didn't make me old. It was the work. Terrible. Okay, anyway. Wow. let's take a look at the answer to that. We'll talk about where everything goes in the financial statements. Maybe that might be a good idea. Breathe for a second, you guys. Boodle. Again, every single time. Computers are not this stupid. They can remember us. Hit the right key. Oh, wait. What did I miss? Zero ones. That's good. 101. You guys have been out here looking at this, right?
Yes.
That's good. Lots of good stuff out here. Look at all those videos. Why would anybody watch all that? Sample tests, quizzes, homework, chapter, what are we on, 4? Okay, these are nice problems, these comprehensive ones. It's everything from 1, 2, and 3, all in one spot. If you can do all of this, you kind of have it made. 700%, then where is it? Oh, I guess that's the size of the font. I'll take it. There's CT problems. Cases and projects. This is how would you approach this monster? By the way, I don't care about the ratios. Remember I told you we're going to have the ratios in the last chapter's ratios, and we're going to have that separate. Do a quiz on that at the end. So they ask for ratios in these problems. Don't worry about the ratios yet. How would you approach this thing? If you looked at this problem, how would you approach a problem like this if I gave you a monster like this? And I'll probably just give you pieces of it because this would take the whole time to do a question like this. But take a look at 4.2. What do they have? All the beginning balances are listed there? And we're on page 215. All the beginning balances are listed there, right? Now these beginning balances are after they made adjustments for this year. You know how I know this is not the beginning balance on the first day of the year? There are balances in revenue expense accounts. What would they be if it was right after you, right when you're starting a new year? What would be the balance in all the revenue expense accounts when you start the new year? 0, of course, because you close the books. So, this is after they've posted all the activity for the year, and they even tell you that, I think. So this is a trial balance, right? What's wrong with these numbers, though? We haven't done any adjusting journal entries for all the deferrals and accruals and depreciation expense and stuff like that yet, right? So we need to do that. Okay, so I think that was true, wasn't it? No, I lied to you. This is after they close the books. Come on, Keith. This is after they close the books. How do I know it's after they close the books? If I could actually look at the page and read. What are the balances in the revenue expense accounts? They're all what? Look at your book on page 215. They're all 0, what, right? The revenues and expenses are all 0. So it's the same explanation, but why are they all 0? Because you close the books. You close revenue and expense to what? Retained earnings. That's how it physically gets into retained earnings so you can start a new year. And we'll look at the closing entry when we get down here. So those are the balances before we did anything. I apologize. So when you start this problem, what do you do, gang? Just go a little bit. Stop it. Okay, anyway. What do? List next to cash, a balance of 5, debit. Receivables, balance of 4. See it? Supplies inventory, balance of 2. Small tools, 6. Equipment, 0. Well, they listed accounts that have no balances in them. I guess we're going to use them later. Accumulated depreciation, 0. See that? They just wrote them all in there. So you put the beginning balance down, and then you start doing transactions. Let's do just the first one, okay? We're going to record them in journal entries, and then we're going to take those journal entries and put them in those T accounts, which represent general ledger accounts. It's called posting. How do you record the first one? Borrowed 20,000 cash. Debit cash, credit notes payable. I know you know how to do these entries now, don't you? The second one is what? Debit equipment, credit cash, and so on, right? We record all these journal entries. I know you can do those now, can't you? Okay? take each one of those then. What happened? Go back up. Take each one of those, there we go, and record them. So the first entry was debit cash, was it? There it is, A20. See the debit? That's posting. So it's just having to do it. So you can see computers do this. People don't, right? Anymore. Can you imagine why people hated bookkeeping jobs? Copying, writing numbers down and copying them? Oh my, go crazy. I've never done this in my life. Account, not a bookkeeper, right? So there's a big difference. Okay, so anyway, debit cash and credit what? It was notes payable, wasn't it? Oh, there it is, 20. Got it? The second one, they bought a piece of equipment, didn't they? It was debit equipment 18, credit cash 18. You just record all of them, and then make sure all your debits and credits, stay in balance. Debits equal credits, and then you add them up after you record them all. That's all there is to it, okay? But now, after you do that, so this is a trial balance at the beginning of the year. After posting all these transactions, A through K, after doing every single one of those, and posting them in there, posting is copying them in, then you total things, and you go through and you try to make the adjusting journal entries, okay? So how would you find out what to do for the first one? Take a look at L on page 216. Supplies of 4,000 and small tools of 8,000 were counted on December 31st, and they say debit remaining expenses. What I'd really do is debit supplies expense, wouldn't you? And I debit tool expense, probably. These are small tools I'm using up, so I'm expensing them in the current period instead of depreciating them. They last a very short periods of time, right? They're small tools. So look at this. If I looked at supplies inventory, they started with 2. They bought 10. What would be the balance in there? See it? Started with 2, bought 10. They got 12, don't they? And now it says they count and there's only 4 left. That's down here. What do you think the adjustment is? Maybe 8. See it? You started with 2. Darn it. Started with 2. Why isn't this pointing? Right? You added 10 to it. There it is. The next line. Okay, right below it. That means you have 12. You count. There's only 4. What do? You take 8 out. Where do you think it goes? They used it. Where's it going to be, everybody? Supplies expense. It's just what we've been doing, isn't it? Anybody see supplies expense there? Oh, they put it in remaining expenses. It's in there. Okay? It's included in remaining expenses down here. Fine. Got the idea? Nobody uses an accounting remaining expenses. They just did much of the activity T accounts. And so if we look at the journal entries, what would they look like? They put everything to remaining expenses. It's crazy. Our adjusting journal entry, come on. We're on L. There it is. The credit supplies for 8,000, debit supplies expense really, remaining expenses. Here's small tools. We used up 1,000 of them. Got the idea? Here's the depreciation. You know how to make depreciation entries. We just did some, huh? You know how to accrue interest, don't you? It's having you do that. And then as you do those entries, what do? Post them to the T accounts, of course, right? To the general ledger. So now, after you do all these adjusting entries, what do you have? If we look back at the T accounts, which represent the general ledger, after you put all of those adjusting entries into these T accounts, where are you? I know how much cash I've got. I know how much receivables I've got. I know how much supplies I've got. Get the idea? I know how much I have of every single asset, every single liability, every single equity account, every revenue, every expense. Now, here there are, I don't know, 50 or 60 entries. How many are there in real life? Millions. We don't care. The computer keeps track of all the debits and credits for us and adds them all up, right? But we always make sure the debits equal the credits that we put in the computer. Even if I'm using scanning, right? I'm scanning groceries at Kroger. Right? I make sure there's a debit, the credit, there's debit cash, credit sales. Right? There's debit cost of goods sold, credit inventory. Got it? You guys are tired. Okay, anyway, now what? Take those balances and make statements. There's an income statement. They just copy the numbers. There's the revenue. There's all the expenses. Add up the expenses, you get total expenses. Take it away from the revenue. You have operating income, and so on, right? There's just revenues and expenses. And you do earnings per share on net income and anything after that. So divided by the number of shares, they give you the number of shares. Now, on the balance sheet, what do you do? On a balance sheet, I would, darn it, just a little, please. We've got too big a file here. Careful. Okay. All right. I list all the assets. I list all the liabilities. I list the equity, but be real careful. What do you need to do for retained earnings there? Still wants to move. What do you want to do for retained earnings, to get retained earnings here? It's the beginning retained earnings plus what? The net income for the current year, and less what? Let me write. What's it going to be, guys? Put it over here. You've got to tie in the current year income into retained earnings. So when I do retained earnings, what happens to retained earnings, everybody? Beginning balance plus any net income, or less the net loss, and less any dividends, true, is the ending. So guess what you're going to put on your balance sheet? You're going to take the beginning, add the net income for the year, or subtract the net loss for the year, and take out any dividends for the year. So let's look at that. Go back to the T account. What's going to be in the T account so far? Retained earnings. What's going to be in there? Beginning balance was 4, and 10 is the dividend. That made it a debit of 6, but then what happened? On your income statement, you have 16 net income. So you add the net income, and that gives you 10. So in my balance sheet, I am showing 10 for ending retained earnings, because that 16 income came into it. That's all, right? So there's my retained earnings of 10. And then look at this. On the equity statement, my beginning stock plus any additional contribution, my additional paid-in capital plus any additional paid-in capital contribution, that's that journal entry for issuing the stock. Retained earnings, beginning, plus net income, less the dividends is ending. That's what's on my balance sheet. Everybody got it? This is easy. Your balance sheet will not balance unless you do what? Pick up the current year net income in retained earnings. That's because you're debiting cash and crediting sales. You got to pick up the sales side. Or debiting accounts receivable and crediting sales. Or debiting unearned revenue and crediting sales, right? The same thing on the expense side. I'm debiting expenses and crediting accounts payable. I'm debiting expenses and crediting prepaids. True? Got it. It's working? Sorry. Okay. Don't start losing confidence on me. Okay, one other thing. When we're done, and we have these financial statements, after you prepare them, the very first thing you do the next year is what? Close the books. This would be January 1st of the next year. January 1st of the next year, what do we want to do? Close all the revenues. They all have credit balances. How do you make them zero? Revenue and gain accounts all have credit balances. Debit them for exactly the amount that's in there. That account had 70,000 in it, so you debit it for 70. What's the balance now? Zero, you start counting a new year. Okay, all of these expense accounts, look what they all got, and loss accounts too. They all have debit balances. We credit them for exactly the balance. What's left in the account? Zero, and you start a new year. And where does the difference go, everybody? Retained earnings. You can run it through income statement if you want, right? Or you go straight to retained earnings. Now we're ready to start a new year. And the reason I like this problem is it has what? Beginning balances, source entries, transactions, adjusting journal entries, do financial statements, and then close the books. That's the whole story. And we start on, okay? Now that you know everything about everything, go away. You guys all look like death warmed over. We're not staying for another 20 minutes. It's probably a reflection of me. No problem. Are we good? Is that helpful? Maybe? Bye, people at home. Aren't you thrilled you don't have to listen to another 24 minutes or 25 of me?